Srimati Nirmala Sitharaman ji tabled the economic survey 2022-23 in the Parliament a short while ago. The economic survey is the strategic blueprint which gives an insight into the state of economy, and it sets the stage for the union budget, which follows a day later. The survey contains new ideas and vision for the future. To hold this press conference, I welcome Chief Economic Advisor Sri V. Ananta Nageshwaran. I also welcome Senior Economic Advisor Sri Raju Misra, Economic Advisor Chandni Raina, Economic Advisor Anuradha Guru, and Economic Advisor Sri Saikat Sarkar. Today's press conference will go as follows. To begin with, the Chief Economic Advisor will make a presentation on the major details of economic survey. Thereafter, there will be question answer from you all. So, over to. Yeah, we can. Sure. Just have to show. You can move. Oh, it's fine. So, over to you, Mr. Nageshwar, please. No, you can start from there.
Good afternoon, everybody. Can you hear me well? So we just spent 1 month of 2023, so you still have 11 more months to go. So I wish you all a very happy and healthy rest of 2023. This morning, we had the International Monetary Fund release its World Economic Outlook update. And they maintained India's GDP forecast or estimate for current financial year at 6.8, next financial year at 6.1, and importantly, for 24-25, they kept India's real GDP growth forecast at 6.8%. So they show an acceleration of India's GDP after a slight dip which they estimate for the next financial year. In fact, the presentation today is going to focus on this aspect, that India's GDP growth is poised to do better in the remainder of this decade, and that is the focus of this economic survey itself. Okay. What, moving? Mm-hmm. देखिए सर It's frozen. Okay. सर हो गया यहाँ से भी हो जाएगा सर ओके Okay. We basically let you admire the cover slide for a bit longer than it needed to be. So, what are the key messages, as I mentioned in the initial remarks? Why is the economic growth going to perform better this decade, remainder of the decade? And what the reforms of the last 8 years have done to make sure that happens? And beyond 2030, what will be India's medium-term growth magnets? And finally, as we look ahead to 2047, what else and what more we could do to realize India's full potential in the Amrit Kal? And if you look at the, is it moving properly on the screens? Okay, thank you. The survey looks ahead to the medium term because the pandemic response and recovery phase is over. In fact, Chapter 1, the title itself says, State of the Economy, Recovery Complete. And therefore, after a long time, we have banking, non-banking and corporate sectors with healthy balance sheets, and they are ready to borrow and lend and invest. So we don't have to speak about pandemic recovery anymore. We have to look ahead to the next phase of India's economic growth process. So why is economic growth going to be better this decade? In order to look ahead to the future, we always have to first look back at the rearview mirror. Let's rewind the tape a little bit. What happened in the first decade of the millennium was a lot of optimism about BRICS economies. By 2002, balance sheets were lean and mean. Companies were willing to borrow, invest, banks were willing to lend. So leverage ratio in the corporate sector and in the overall non-financial private sector rose very sharply in the first decade. And it got to the point where the credit to GDP ratio in actual terms was much higher than the trend in the first decade of the millennium. That is what you see. The middle hump is basically actual credit GDP ratio was well above trend, and it persisted for a long time. And because it was quite well above trend and also lasted longer, naturally, it led to a period of excess borrowing and excess lending. And the second decade was a payback time. So India went through a classic financial cycle, credit boom and credit bust. And this is not something new for the world. Every time you go through a financial boom and bust, it does leave its impact on economic growth. And that is what happened to us, especially in the second half of last decade. And you can see this here. Look at this chart. From 1980 to 2000, the bank credit to GDP ratio was roughly around between 25 and 30%. And then it jumped from 25 to 55, 60%, and spent the second decade of this millennium hovering in that range. This is the digestion process. So there was massive expansion. Remember, this is a ratio. GDP went up, but the bank credit expanded even more than GDP growth, and naturally, such a big spike within a space of 10 years, what we could not achieve in the previous 20 years, naturally had to lead to some kind of a credit indigestion problem, which had to be adjusted in the second decade. And now, that process of indigestion that has been sorted out, and the balance sheets are repaired now, and banks' non-performing ratio, whether it is scheduled commercial banks in general or public sector banks, they are lower now. And you can see that also banks have done so partly through recapitalization, raising fresh equity, and also through higher provisioning. So bank balance sheets are repaired, and that is why you see that in the credit growth picking up. You look at credit growth across sectors, agriculture, industry, services and personal sector, housing loans and car loans, etc. The growth rate is now sustainably above double digits. And this is a sign that this is what we were missing towards the second half of last decade because of balance sheet issues. So to quickly summarize exactly what happened was 2005 to 12, credit boom that led to balance sheet stress later, phase of a higher non-performing assets due to past forbearance. And then, by the time we could repair, just want to leave one statistic with you. The non-financial private sector leverage ratio, debt to GDP, went up by 40 percentage points in the first decade, from 2000 to 2010. And from 2010 to 2018, it came down by 30 percentage points. And by 2018, that was kind of done, it had bottomed out, but before we could start expecting corporates to borrow and banks to lend, came the collapse of IL&FS and some housing finance companies. And by the time we got a grip on that problem, came the pandemic. That lasted 2 years. And then 2022, we had the commodity price shock and synchronized monetary policy tightening after a very long time in the developed world. So it's a case of balance sheet stress followed by successive one-off exogenous or external shocks that have basically prevented the impact of economic reforms pursued by the government on economic growth. We would have seen the results already, but for these successive one-off shocks on the back of a fairly large credit boom that turned into a bust. The reforms of the last 8 years, which I just now mentioned to you, basically spans multiple dimensions. It is not purely about economic reforms for higher growth. It is also about inclusive growth, financial inclusion, banking cleanup, the creation of the digital public infrastructure, which I think I'm going to talk about a bit later as well, and contribution to healthy India, ease of living, and continuing on to the next slide, physical infrastructure creation, facilitating investments, transparent taxes and tax administration, ease of doing business, and farmers' welfare. So broadly speaking, about 10 areas we have covered here. These reforms were happening even as the banking cleanup was going on. And this episode between 2014 and 2022 has a lot of parallel to what happened between 98 and 2002 as well. Then, as now, the banking system was coming out of an NPA crisis, and there were sanctions on India after the nuclear device was tested in Pokhran in 98, and deleveraging was getting on in the banking and corporate sector. There were 2 successive droughts. The technology boom ended, internet boom ended in 1999-2000, and the US recession followed, 9/11 happened. But amidst all these shocks, interest rates were deregulated, privatization was pursued vigorously, and the first foundations of the insolvency and bankruptcy regime was laid with the asset recovery mechanisms. The FRBM Act was introduced, and today's digital infrastructure, which we talk about, the foundation for that was laid with telecom reforms in that era. But obviously, there is a lagged effect for these reforms to show through in the data because underlying conditions had to turn favorable. We talk of public digital infrastructure. Okay. I think it's not enough if I just look at the screen, right? Yes. I'm reminded of what economist Joan Robinson said in the 1960s about India. Whatever you say about India, the opposite is equally true. That's what she said. And so anyway, the parallels to the 1998-2002 period, to this period is that even as a crisis was being addressed, economic reforms were pursued, and when underlying conditions turned favorable, the lagged effect of reforms showed through. That's exactly what is reflected, for example, in the IMF forecast, and that is what we expect in the medium term as well. The lagged effect of the reforms will show through because in the last several years, the full effect of the reforms could not be felt in the data because of successive one-off shocks. And that's why we talk about the medium-term growth magnets for the economy. The entire philosophy of economic management revolves around making it easier for people to pursue their economic activities in individual lives or for businesses, and ultimately leading to efficient resource allocation and more importantly, enhancing the potential of the economy to grow at a higher rate. And that includes, obviously, it is an indicative list and not a complete list, agricultural growth, a trust-based governance model, public goods for inclusive growth, both infrastructure, digital and physical, and many other things which will come under that, involving the private sector, and more importantly, managing the energy transition, reducing our dependence, and also addressing climate change issues as well. It is not about the government doing things for the people, but also involving people in the process. Everybody is a participant in the development process. That is why it is Sabka Saath, Sabka Vikas. So it is not just a government being an enabler, but government being a partner to economic growth. First, we deal with one of the pillars, agricultural growth. Thanks to many of the initiatives which you see around this slide, what you see is that the share of private sector investment or capital formation in agriculture has reached a level which is higher in the last 12 years. Since 2013-14, 9.3% of overall gross capital formation is contributed by the private sector in agricultural sector. And it has been facilitated by the creation of the Agricultural Infrastructure Fund, a national agriculture market which has linked farmers with direct buyers, FPOs which take into account organic farming options as well, and more importantly for the farmer, income support as well as risk management through crop insurance. All of these things have paved the way for greater participation of the private sector in capital formation in the agricultural sector. This sector is no longer about being a primary sector. It also has tremendous export potential, as we have been observing lately in our merchandise goods data for the last several years. What about the trust-based governance model, the second pillar of the development and growth strategy? The Insolvency Bankruptcy Code restores trust between the borrower and the lender. The borrower has an exit option and so does the lender. And that is the key to this. And the important thing is, more than 7 lakh cases, even before they come into the IBC process, have actually gotten resolved before they enter the process. And that is the most important thing, which doesn't get captured in the data. The usefulness of IBC is in ensuring borrower payment culture even before they enter into a resolution process. Ease of doing business, one illustrative example is the Real Estate Development Regulation Act, which has ensured trust between developers and buyers, making them more transparent and check-based transactions rather than relying on black money. Effective governance is about making sure that the public don't feel threatened by legislations and rules and regulations, and every time they commit a mistake innocuously, it need not be deemed a criminal offense. So decriminalization of many provisions of Companies Act and several other economic offenses restores trust between the governing and the governed as well. And in terms of the trust with respect to public accounts and public money, there are many dimensions. It is not just about the quality of expenditure that has gone up in recent years. Of course, capital expenditure in government budget has gone up from 12% to 19% in the last 5 years, and revenue expenditure share has gone down. However, it is not just about the quality of expenditure improvement. The way the government has become more transparent with respect to the budget deficit numbers, the prudential assumptions being made for budget deficit calculations, etc., expenditure management, making sure that public procurement is transparent and enables everyone to compete and have a fair shot at becoming a supplier to the government. All these things are part of fiscal and public expenditure management. Now, moving on to the more macro dimension of it, if you look at the last 16 years, there is much talk about today of India's high deficit debt to GDP ratio. You can see that among the countries that saw very little increase in the public debt to GDP ratio, India is one of them. India, Germany, and Indonesia in the last 16 years. In fact, you will see in the survey in Chapter 3, we have done an exercise, a counterfactual exercise. In 2019-20, 2021 and 21-22, instead of the actual nominal GDP growth rates which we experienced, if only the economy had continued to grow at a rate of 10% nominal terms, the fiscal deficit and debt ratios would be a lot lower than where they are today. The point is, because of India's growth dynamics and the cost of capital being lower than the nominal GDP growth, there is enough scope for the fiscal parameters to improve in the coming years once we achieve sustained and steady growth as we expect. And that you will see in Chapter 3 on the fiscal side. Creating public goods for inclusive growth, that is the third pillar. And it is not only about physical infrastructure, although it is an important part of it, in terms of the amount of kilometers of highways completed, electricity installed capacity. This is RBI showing that in 2011, if you put them as an index value of 100, where they stand today in 2020, excepting the case of railway track, which because much of it was laid already, and therefore even a 14% improvement in 9 years in terms of 8,000 kilometers added is a very big number. But in every other case, national highways or cargo handling capacity, the growth rate is 80% or doubled in the last 10 years or so. And on the softer policy side, apart from physical milestones, you have public-private partnerships, the national infrastructure pipeline, the national monetization pipeline, which will improve economic efficiency, as I mentioned earlier, and the PM Gati Shakti, which is still in its early years. The underlying purpose of it is to make sure that public investment projects get completed without cost and time overruns, and there is synergy between various departments such a way that sequencing happens naturally and logically, and therefore delays are minimized. So PM Gati Shakti is about reducing information asymmetries and making sure that government projects are executed on time and within cost estimates. The national logistics policy is an important cog in the wheel. Our export competitiveness is hampered by the fact that logistics costs constitute 14 to 15%. The goal is to halve it and bring it down to international levels, and this national logistics policy will play a very important part in that. The public digital infrastructure, about which now there is a lot of justified optimism on India, not only in the country but outside as well. The initial phase of reforms started with the identity and then the Jan Dhan Yojana, financial inclusion, Aadhaar and mobile. And then it moved on to unified payment interface, which allows even payment as small as 2 rupees through a barcode, common service centers for IT-enabled services, PM Disha, digital DigiLocker, BharatNet, and services at a click. Now, they have set the stage for new age reforms, which is now going to make sure that hitherto neglected segments of society, low-income households and micro businesses, get a fair shot at accessing national and international markets and getting funded by financial institutions. These digital developments allow all of them to leave their digital footprint, which creates a credit history for them, so that they are able to access finance as well as access markets. And that is the potential of digital infrastructure. Even though it's almost 5-6 years old since the beginning, formal study of how much digital infrastructure contributes to growth is yet to be undertaken. But it is my belief that India's improved balance sheets, and the digital infrastructure together will add anywhere between 60 to 100 basis points to India's potential GDP growth, which is what we were missing in the course of the second decade. This is an elevation and enhancement in India's potential GDP growth because the baseline is assumed to be around 6% by many international organizations. But what is important is we have a financial cycle that was disrupted in the second decade. That is coming back. And we have the new development public digital infrastructure that is adding another 30 to 50 basis points. So together, these two developments add about 50 to 100 basis points to the trend growth which many organizations pegged for India at 6%. And that is why my optimism is that in the coming decade, rest of the decade, the potential GDP growth without taking into account export potential, because the global economy is still rife with uncertainty, the growth rate could be around 6.5% to 7% rather than between 6 and 6.5%. Ultimately, economic growth is only a means to an end. And what is that end? The end is prosperous and dignified living for citizens. And therefore, basically, the chapter on the social sector, in a departure from the previous economic surveys, we have actually brought it to the front of the economic survey. After the initial state of the economy, medium-term outlook, fiscal and monetary affairs, inflation, the sixth chapter in the survey is on social sector, and perhaps it is the longest and the biggest chapter in the entire economic survey this year. And there is a reason for it, both in terms of its placement and its size, because the interventions made by the government have been substantial, and it is to make sure that no one is left behind. This is about inclusive growth. And as you can see here, and the survey, not only the full document, but the highlights also capture the elements of this with outcomes as well, ranging from electricity, healthcare, food security, affordable housing, drinking water and sanitation, all the way to cooking fuel, all-weather roads and skill development. Outlays have become outcomes, and they are covered in detail in the social chapter. More specifically, in terms of outcomes, you can see here, general government spending, both union and state governments put together. Education spending has gone up from 5.3 lakh crores to 7.6 lakh crores, and health almost more than doubled in the last 3 years. And other than health and education, we have gone up from 4.86 lakh crores to 8.3 lakh crores approximately. The outcomes are seen on the right side. Primary school dropout rate has come down from around 4.7% down to 1.5. The pupil to teacher ratio has improved from 34 to 26, and there are going to be 14,500 PM Shri schools to be established in the next 4 or 5 years. And while we are seeing the pupil to teacher ratio improvement happens, it is a matter of time before they also show up with respect to the cognitive and non-cognitive skill proficiencies of our students in the primary and middle school. Health and education are two important pillars of any family's life. So the gamut of health initiatives, starting from the National Health Policy on your bottom left, continuing all the way in 2022 up to Pradhan Mantri TB Mukt Bharat Abhiyan to end TB by 2025, National Tele-Mental Health Program. Of course, it will be a travesty if I leave out the successful COVID vaccination program. You only have to look at several other countries to understand how important a role this has played in ensuring a quick turnaround of the economy and restoration of normalcy in our own daily activities. 2.2 billion doses and still counting. And that is a success of the not only the vaccination planning and execution, but also its role in economic recovery process. Again, it is not enough just to speak about the policies, but also important to mention the outcomes. Maternal mortality ratio has come down in the last 7 years, 167 to 97. Child mortality ratio has dropped from 45 to 32. And under 5 mortality ratio has dropped from 39 to 28. Because of these, and because of government's health insurance programs, a family that used to spend nearly 2/3 of health expenditure on its own is now spending only 48%. And stunting under 5 children is down by about 3 percentage points, and institutional delivery births have gone up from 79% to 89% in the country, which is a good sign, which means it will naturally have an important role in reducing both infant and under 5 mortality, as well as more and more institutional births happen. What about the private sector participation? Well, the tax cuts of 2019 played a big role in ensuring that the private sector was able to repair its balance sheets quickly and consider investing, about which I will show the evidence later. And this also has paved the way for production-linked incentive scheme to be implemented. This scheme is a very important strategic decision. If you look at the history of East Asia, there was active industrial policy that played a big role in them joining the first world within a space of a single generation. An industrial policy that does not so much as reward winners but punish the laggards is what East Asia did. And today India sees an opening in the global supply chain. Countries are willing to diversify, not only because of pandemic but also because of political reasons. Just-in-time inventory management has given way to just-in-case inventory management, and it is about friend-shoring, etc. And therefore India sees an opportunity. There was a talk of India having prematurely deindustrialized. I would say that India simply had not industrialized enough. There was never a premature deindustrialization. Infrastructure was missing and manufacturing at scale was missing. These two missing gaps have been now plugged with the creation of physical and digital infrastructure and the PLI policy, which basically ensures that India is able to create global scale in local manufacturing for export markets. And the important thing to remember is PLI is a portfolio approach, and there is no payment in anticipation of performance. Payment of incentives happens after the units perform and deliver excess production over and above their benchmark. If they don't produce, they don't get the incentive. So it is a payment against performance and not payment in anticipation of performance. National monetization pipeline is going to unlock the productivity of public assets through leasing or outright sale, and this investment you saw in the privatization of Air India, and it is clear that the government also articulated its policy towards public sector enterprises, hoping to retain its presence only in core sectors and exiting non-core sectors. Foreign investment licensing norms have been liberalized. There is automatic route for more sectors now, 100% automatic FDI, and there is a single window facilitation portal, the outcome of which is seen in the actual gross FDI inflows. The blue line shows you. As a percentage of GDP as well, it has gone up from 2.2% to 2.6% of GDP. And ultimately, the various investments, whether it is domestic or foreign, have to translate into employment. Urban unemployment ratio has come down during the pandemic peak of around 20% down to 7%. And the worker population ratio has picked up from a low of around 35% back to around 45%. EPFO payroll data, which tracks new workers joining the scheme with salaries of 15,000 or below, in 22-23, their levels are running well above the previous 3 years. And in terms of the facilitation of employment, the eShram portal provides a bridge between employers and informal workers, and the National Career Service has registered 2.8 crore job seekers and 6.8 lakh employers as well. So what is going to happen is that as the private sector investment begins to kick in, and as the construction sector comes back to life with rural migrants getting back to their urban employment opportunities, the employment scenario will pick up as it did in the first decade as well. In the first decade, the capital expenditure resulted in employment generation, and that is a phase that India is looking ahead to in the coming years as well. Micro and small businesses, we all know that India has a preponderance of micro businesses, but the recent changes in changing the threshold, and also adding a new criteria turnover apart from investment, and more importantly, the provision of emergency credit line guarantee scheme during the pandemic have enabled that this sector remains in good health. And the evidence of it is what we see. GST paid by micro, small and medium enterprises didn't really flag or slacken in the pandemic year. They kept up. If anything, they registered gradual increases from 18-19 all the way to 21-22 as well. Energy transition. This is both a matter of security, energy security, as well as ensuring that India deals with climate change. India is well ahead of its target for renewable energy mix in the overall energy mix balance. And we have 8 missions now addressing climate concerns. We updated our nationally defined contributions in COP27, and there is a national green hydrogen mission launched, and the sovereign green bond, the first tranche of $1 billion was just auctioned. We got a better yield. They were able to sell the green bond at a 6 basis point lower than the conventional sovereign borrowing cost. And there will be one more coming in the current financial year. All these issues are covered, apart from the global dynamics of climate change, etc., in the chapter on climate and environment. Of course, for most of you, while the medium-term picture is important, for some of you, obviously, what is interesting and what is exciting from the point of view of near-term attention is what is the growth rate that the survey projects for the next financial year. So we are now, after having discussed the medium-term prospects, which are now looking good because cleaned up balance sheets and reforms are going to have a lagged payback. Where we are today is that the numbers which we have up to the end of second quarter in September, July to September, the momentum is continuing in the economy. If you look at the industrial production, consumer durables, infrastructure and construction goods and manufacturing, they are running at a rate better than they were in the previous 2 years. And the middle portion is very important. 10 out of 10 sectors in the private listed company space, all these sectors, investments undertaken by companies in the first half of 22-23 is higher than what it was in the first half of FY 21-22. On the right side, what you see is a proxy for contact-based services. Leisure, tourism, hospitality, domestic and foreign travel, all of them we are trying to proxy with this one number, showing that by and large, air passenger and cargo traffic are now running at more than 90% of the pre-pandemic levels. And as I mentioned earlier, credit growth is picking up across different sectors, MSMEs, large industry, services, and non-food credit. All of them are growing at more than double-digit rates. And even NBFCs, as you can see on the right side, their credit disbursal is also rising. And in general, credit to MSMEs is now, on an average, has grown at around 30% since January 2022. And not only the banking system, but also the non-banking financial corporations, their non-performing assets are lower than they were 15 months ago or 18 months ago. Therefore, the survey projects the economic growth rate to be 6.5% for the next financial year, and the range we have projected for the outcomes is between 6 and 6.8%. Baseline is 6.5%. The range is 6 to 6.8. Some of you might think the range is asymmetric in nature, and it is deliberate. Because we do understand that the global political and economic environment remains still rife with uncertainty. We have many known unknowns as well as unknown unknowns, and we also do not know how the speed with which global economy recovers will lead to the kind of inflation pressures that we saw last year. China reopened fairly rapidly, and as of now, the United States economy looks set to avoid a full-fledged formal recession, and therefore this January already we have seen crude oil prices and industrial metal prices higher than they were at the end of December. From the Indian standpoint, a moderate to somewhat significant global economic slowdown will be on balance a better outcome. because it would lead to lower commodity prices and a cessation of interest rate tightening in the developed world, weaker dollar, etc. Therefore, in order to make sure that we fully accommodate the downside risks, the band has been kept at 6 to 6.8 and the baseline number at 6.5%. This number is very much in line with what international organizations have predicted, including what the IMF said this morning. So therefore, ladies and gentlemen, we have basically come to the end of the presentation, and in this last slide, as I mentioned at the very beginning, what more can be done to ensure that the potential GDP growth does not stop at 6.5 to 7%, but goes beyond that, even if global growth and export prospects remain somewhat moderate. India has the potential to enhance its GDP growth by attending to many of the domestic challenges in itself, including starting with administrative reforms and enforcement of contracts, leading to what I always say, divesting from life insurance corporation is one thing, but divesting from license, inspection, and compliance, that is more important. So that has to happen at the level of union government, state governments, and local governments. And finally, our aspiration to become a global manufacturing powerhouse will not be served unless we are able to ensure affordable, reliable, and economically viable power supply throughout the country. And we have to make sure that we reduce the dependence on fossil fuels and ensure availability of rare earths and critical minerals to make the switch to renewable energy. And no country that is developed today has managed to reach this far without having a viable Mittelstand, the small medium enterprise sector. So we have to continue to pursue what we have been doing in the last several years, ensuring that the MSME sector becomes more and more formalized. The skilling and education envisaged under the new education policy has to be pursued, because 21st century challenges are going to be different from the previous century. Old age care, elder care, mental health, living with the green economy, all these things are not something that our education system was prepared for earlier. Therefore, that has to be addressed as well. And we have to make sure that women are able to contribute as much to economic productivity and activity as they are capable of. And today's Republic Day, this year's presentation focused very much on Nari Shakti as well. And even in the economic space, we have to make sure that whatever is feasible legislatively and in terms of law and order, physical security, work from home, and childcare, or whatever governments need to do, they have to do to be able to let our women make the choice for themselves between working and addressing their family priorities as well. And they shouldn't be in a position to having to choose between the two. They should be able to perform both those activities if they desire to do so. And that is what will enhance economic growth as well. So overall, if we are able to address these pending issues as well, our future up to the centenary of India's independence and beyond will be brighter than what it has ever been. So this year's economic survey comes to you in 3 volumes: the main document, the statistical appendix, and more importantly, an economic survey highlights giving some of the statistical information. And many of the charts and the tables which are there will be uploaded as Excel files as well for you to download and look at the data yourself and make use of them. So I hope this presentation has given you a glimpse of what the survey contains and has whetted your appetite to dive deeper into the parent documents. Thank you for your patient listening. Thank you.
Yeah, Sunil. Yes, 255.
First of all, many congratulations on the presentation. Just one, your predecessor in the last presentation had said very categorically about oil prices and had factored in the last time round. The economic survey, when Mr. Sanyal had presented, had talked about the oil prices and what is the projection in terms of growth rate. Today you have given a 6.8 to 6. where do you see the oil prices and how much will that be a factor in the overall situation?
No, it is difficult for us to give a prediction for the oil price. RBI takes a number that is below $100 per barrel, and we can live with that number and be able to achieve the growth rates that we have projected in the survey. So therefore, at this point, it will be difficult for me to come up with a precise number because the uncertainties with respect to the oil market are tremendous. You can only talk about it. As long as they stay at a number that is less than $100 per barrel, I think the real GDP growth projections will remain undisturbed. The inflation projections that the Reserve Bank of India has made is that it will come to lower than the 5% range in the course of the next financial year. But there again, I would submit, in fact, my advisor, Mr. Saikat Sarkar, has written an article which will probably appear tomorrow. There again, I think the baseline we expect, if the global economy slows down as IMF and many people project, then commodity prices should retreat because on the back of the monetary tightening that has happened in 2022. In that case, in fact, if you notice, many of the analysts in the Indian financial community are expecting a much lower wholesale price index inflation, etc., in the course of next financial year. So the baseline assumption is that inflation should not be as big a problem as it was in 2022, but we would concede that the uncertainty still remains high. Do you want to add anything, Saikat? Please.
Actually, we have seen the consumer price index, combined, come down, for the last 3-4 months consistently. And it is below the RBI tolerance limit of 6%. And we hope that it will come down further because some of the commodities, the prices of some of the commodities are coming down, right? Another thing is the wholesale price index. It has come down below 5%. That is it has come down to 4.95% in December. And wholesale price index, because it is related to input costs, and so that has a lagged effect on the consumer price index also. So we are also hopeful that this pass-through will happen, and it will have a positive effect. Positive means negative effect on the prices, consumer prices. That is, inflation will ease further. Retail inflation.
Hello, sir.